Matthew Bell here with Alzheimer'sProof.com again, and today I want to expand on something that I have touched on in another video, and that is using life insurance to pay for long-term care. Now, I have a video where I discuss the various ways of paying for long-term care. Private paying it, Medicaid spend downs, we talk about Medicaid trusts a bit, talk about life insurance in that video. I wanted to expand upon the conversation of talking about the use of life insurance for paying for long-term care, just because it's a little bit lesser known than some of the other methods. Again, caveats, I'm not a lawyer, this isn't legal advice, although I am licensed in the sale of life insurance and health insurance products. I can't represent any audience member without sitting down and doing an evaluation. I may not be licensed in your state, and so none of what I'm about to say should be construed as financial, insurance, legal, or any type of specific advice. This is simply for general, informational, or entertainment purposes only. I'm trying to give you research leads and just some ideas to think about when you're making decisions for your family, and I would encourage you to sit down with a competent, qualified, licensed broker or insurance agent if you're interested in discussing any of these things further and how they might apply to you and your family. So again, this is a conversation, I think, because the use of life insurance to pay for or to restore the money that's been paid for long-term care is an option that I think maybe more people would find attractive if they actually were aware of it. Because frankly, when you use long-term care proceeds, you may or may not need them for long-term care. A long-term care policy may or may not pay out, depending on whether or not you actually need long-term care. But a life insurance policy is essentially guaranteed to pay out if you pay the premiums and keep it in force, because you're going to die eventually, regardless of whether you need long-term care or not. So there's really three ways that a life insurance policy can be used to help pay or to pay for long-term care. The first way is with the cash value. So for life insurance policies that have cash value, this is not going to be term policies, but it would be whole life policies that have some cash component. The cash component can be used to pay for long-term care. There are generally no restrictions on what cash value can be used for. You can use it for new golf clubs or a new boat. Wouldn't recommend it necessarily, but you could. Some people use whole life policies to help pay for college education for the kids. They might use cash value to do a kind of bank on yourself kind of an idea, maybe for home repairs or just because they have already taken distributions from 401k and maybe they don't want to take the tax hit that particular year. So there's all kinds of reasons and applications for utilizing the cash value in a whole life policy, and long-term care is one. Since there are no restrictions, you could use the cash value to pay for in-home care, assisted living. You could use it to pay for hospice, respite care, or it could go toward nursing home care. Now is not the place for me to rehearse all of the predicted costs that are associated with long-term care, but suffice it to say that they're quite large. We're talking in the neighborhood of $75, $80, $90, $100,000 or more dollars per year to pay for care in a nursing home setting. Even though home care is going to be less than that, assisted living probably somewhere in between, still we're talking about a significant chunk of money. So it may be that a whole life policy is not going to have sufficient cash value in it to really meaningfully contribute to some of these costs. But for some people who may need extra money to pay just for assisted living or to pay for some home care or to pay for home modifications, you shouldn't forget that cash value can be used for that purpose. The second way in which an insurance policy can be used for payment for long-term care, a life insurance policy, is through what's called an acceleration of the death benefit. So this is going to be a more meaningful contribution to long-term care costs, especially where those costs, again, can exceed $70,000, $80,000 in a given year. It's more likely that the death benefit is going to be in that vicinity than that the cash value may be for a lot of policies. Depends on how the policy's been set up and funded, but death benefit might be, again, a more meaningful contributor to some of those expenses. So the way it kind of works would be there would be some sort of an acceleration. The percentage of the acceleration would be specified in the contract. It could be any real number, I suppose, but 25%, 50%, 75%, 90%, there's going to be some percentage that's going to be allowed to be accessed prior to the death of the insured. And as an acceleration of the death benefit, it's usually tax-free if that acceleration qualifies. So some restrictions would be oftentimes if it is a particular accelerated rider that has to do with long-term care, it may require that the person be in a nursing home setting. It may be written in a different way. It may allow for an acceleration to be applied towards assisted living or home care. You'd have to read the fine print in the contract. But it is good to know that in some cases, the policy's death benefit can be accessed in advance of the person's death. And sometimes that's for terminal illness, or it could be for a chronic illness. Not all policies, not all whole life policies or others are going to have this rider. Sometimes Universal Life might have a rider similar to this. There are any number of different policies that might, but it would have had to be a discussion with the agent who wrote the policy in the first place. It was probably mentioned. You would have been paying for the rider mostly. Some riders are funded up front. Some riders are funded when you actually take an acceleration, and I'll talk about that more in just a moment. The third way that a life policy might be used to pay for long-term care is via indemnification. And what I mean by that is if a particular sum of money is spent on long-term care for an individual, and that individual had his or her life insured for that amount or a similar amount, then on the passing of that particular individual, their death proceed would essentially restore the funds that were spent on their care. Now, we don't have a crystal ball. None of us knows exactly what is going to happen, but again, with certain probabilities, with certain numbers in place, we can make guesses about the number of people who will need care and the approximate cost of that care. For men, I've mentioned this in another video, they typically, if they need long-term care, will go in a facility for about 1 to 3 years. Women may be from 2 to 5 years. Cost of care can range from $75,000 to $150,000, depending on your area, depending on the amenities available at the facility, whether memory care is needed, and there are a number of other factors. But the median cost I've been using is about $100,000, just because the numbers are easy, which means average cost of care for a man be between about $100,000 and $300,000, and for a woman between about $200,000 to $500,000, and for a married couple, if they both needed care, between about $300,000 and $800,000. And so that's a considerable chunk of money. When you are planning for your final expenses, when you're planning for long-term care, you can think about maybe a composite strategy where you might have a long-term care policy. You might also utilize a life insurance policy just to try to tailor the death benefit to the projected cost of care. So some people, again, as I said in the preface, prefer to use life insurance because it's guaranteed to pay out. So if you wrote $400,000 policies on the husband and the wife in expectation of them possibly needing care, life insurance policies, then if they didn't need care, that $400,000 apiece would be just extra to go toward legacy, estate planning, survivorship for retirement, or whatever. But if they did need care, then there's a good possibility that that amount is going to be fairly well tailored to the amount that was actually spent on their care. Could be plus or could be minus, but it'll be in the vicinity, and at least the family will not have suffered the same amount of loss that it would without those policies available. So the three different ways: the cash value in a policy that has cash value, like a whole life policy; the accelerated death benefit for a policy that has that rider; and indemnification, which is simply the use of the death benefit to restore the funds that were spent on long-term care. And a death benefit is just what life insurance is. So that third option would apply to any life insurance policy of any kind, term, whole life, universal life. Having said that, asterisk, term policies in the type of age bracket we're talking about are probably unlikely to be in place, because it's probably going to be permanent insurance, something like whole life, possibly universal life, depending on if it was set up correctly or not. But those options are basically three that people may not be aware of. Just give you some pros and cons. Again, as I mentioned earlier, one pro of using life insurance is that it's guaranteed to pay out. So you might put money into a long-term care policy, you may need it, you may not need it. Money spent into a life policy that stays in force until the day the insured dies, is guaranteed to pay out. You might also be able to use a life policy strategy to sort of pull double duty. And this might be double duty with the cash value or with a death benefit. And what I mean by double duty is simply that a long-term care policy is specifically geared toward one thing, paying for long-term care. Maybe in nursing home, in assisted living, at home, respite care, or wherever that context is. But that policy is geared toward and has certain qualifying and eligibility triggers and requirements. Life policy, cash value can be used for any purpose. So, for example, let's say you pass an age where you feel like your risk of long-term care is now passing. I don't mean to say that it's from a statistical standpoint, age is a risk factor, and so the older you live, the more chance you have. But you may reach a certain age where, let's say mom or dad already had dementia by that age, and you feel like, well, you know what, I'm going to use the cash value to buy vacation, for my family or something. I'm not saying that is necessarily the best idea, but I'm saying the cash value has the ability to be used for any purpose whatsoever in a life policy. And so if it's not needed for long-term care or not wanted for long-term care, it can be used for other purposes. Similarly, the death benefit can be used for any purpose. It can be used for funeral expenses. It can be used to set up an education fund, an emergency fund. It could be used for income replacement, to set up a legacy, for retirement planning, and it could be used to restore funds that were spent on long-term care. But if it's not needed for that, the funds are going to pay out regardless. It's not like a life policy that pays out. The company's going to say, well, wait a minute, this policy was written for long-term care and your loved one didn't need long-term care, so therefore we're not paying the death benefit. The death benefit pays on the death of the insured, period. And if those funds were not used, if the funds in a person's, let's say, a portfolio of assets was not used, or their income was not used to pay for long-term care, then the death proceed from the life policy is just going to be icing on the cake. A couple of cons. Number one, life policy is not going to be tax qualified the way some long-term care policies can be. So in principle, a long-term care premium can be tax deductible, but you're going to have to consult a tax preparer to get the actual eligibility requirements for that. Generally, you have to itemize, and your expenses have to be greater than 10% of your adjusted gross income. But if there are other stipulations, I am not an accountant or a tax expert. I cannot give you tax advice. Suffice it to say, some long-term care policies are tax qualified and some are not. Life insurance policies are generally not. Number two, the life policy is not going to have as much cash likely as the cash would be available in a long-term care policy. So usually long-term care policies, once they are triggered, once a person's eligible to receive benefits, there's probably going to be more bang for your buck in the long-term care policy than in the cash value of a life insurance policy. Death benefit is different. So if you have an acceleration of the death benefit, we might be talking about a different calculus. But cash value-wise, the life policy is probably going to have a little bit less punch to it. Another thing is the accelerations to the death benefit could be discounted. Now, I said earlier, sometimes when there is a rider, there are long-term care riders, there are chronic illness riders. Sometimes you pay for the rider as you go along, and other times the rider is paid for if you need it. So in some cases, there might be a discounting that's applied to an acceleration, and let's say you apply for a 50% acceleration on a $100,000 policy, you might not actually get a check for $50,000. There could be an expense loading that's taken from that. There could be a mortality discount that's applied because you did not live as long or pay as much into the policy as the insurer thought you would. So some of these, they're going to be in the fine print. It's probably still going to help. I mean, if you got a check for $25,000, it may still help your family, but you should be aware that the accelerations may not be sort of dollar for dollar. Finally, the accelerations are sometimes only available for certain uses. So, for example, one acceleration for a chronic illness rider might stipulate that the person has to be in a nursing home, has to be long-term care qualified, and has to demonstrate that they're in a nursing home, versus, let's say, a long-term care policy which may pay out, depending on how it's written and what kind of policy you have, may pay out for home care, respite care, hospice, and the like of that. So the bottom line is, you want to consult with somebody in your area who is licensed and knowledgeable about these products. You want to disclose what the total family situation is. You want to talk about your values, your purposes. You want to talk about other assets and resources you might have available, and just survey the landscape and try to determine what option, if any, is going to be correct for your family. And I hope something that I've said today is of value to you. If so, I would ask that you just please click the like button, subscribe to the channel. We're going to have other videos in line that may have to do with finances, and we're going to have to do with diet and exercise and many other things that have to do with Alzheimer's. And I thank you for being with me today. Thanks a lot.